All right, what's up, everyone? In today's video, we're going to be looking at another chart layout here. We've got the U.S. gasoline fund on top, and we've got a chart measuring inflation expectations on the bottom. I'm going to break down how to use this chart and why I like it so much and why I think it's important for you guys to pay attention to. Now, this intermarket relationship chart compares the U.S. gasoline fund, ticker symbol UGA, with inflation expectations represented by the ratio of Treasury inflation protected securities, which is the TIP, ticker symbol TIP, to nominal yielding treasuries, the IEF. All right, ticker symbol IEF. Investors use this chart to analyze the relationship between gasoline prices and inflation expectations. Rising gasoline prices often lead to higher inflation expectations as fuel costs impact various economic sectors. Conversely, declining gasoline prices can ease inflationary pressures. By monitoring these indicators, investors can make informed decisions regarding inflation-sensitive assets and adjust their portfolios accordingly. Observing the correlation between UGA and the TIP-IEF ratio helps investors anticipate changes in inflation trends and adjust their investment strategies to hedge against inflation or capitalize on deflationary periods. Now, if that's a little bit too much of market lingo for you, I'll break it down even simpler in this explanation, right? Gasoline, everything gets transported, okay? It doesn't get manufactured in one place and magically appear, at a distributor or in the consumer's, hands, right? No matter what it is. Everything basically comes off of a truck, right? As you want to say, right? Whether it's a ship, airplane, a truck, all of these things are being transported, and gasoline oftentimes is what fuels that transportation costs. So if there's higher transportation costs, well, that usually tends to spill over into the price of the goods or services being offered, right? So that's why we monitor the gasoline fund. And we, talked about, this relationship that can have with inflation. If gasoline prices are going higher, transportation costs are going higher, then oftentimes you will see people, pass that down to the purchaser, right? To the buyer of these goods. And so you'll see inflation start to potentially rise, right? So with that being said, what we were looking at here was really interesting, what we saw most recently. Now, I was looking at this, and the way that I like to use this is by longing or shorting treasuries. Okay, specifically TLT is the one that I like to trade. There's futures, there's different bond ETFs and different things that you guys can trade and try to capitalize on. But at the moment when I was watching this, I was saying, hey, this is forming a base here, trying to break out potentially above previous highs. This was forming a base trying to break out above previous highs. And I thought that we would see the follow through in the gasoline fund that we saw in this inflation chart here. And so I was shorting TLT, I was shorting bonds at the moment, basically making a bet that I think yields are going to go higher, that yields are going to rise. Why would yields rise? Why is this chart even important? Why does inflation matter right now? Well, Jerome Powell has the entire stock market, basically the entire world's attention, and US CPI has the entire world's, attention. And so inflation and all of these things are, they CPI used to just be another economic data report, right? We get all types of economic data reports, inflation reports, labor market reports. And now over the past couple years, they have everyone's attention. So they are all market moving events, right? That you can day trade off of or potentially swing trade off of. So when I was seeing this, I was saying, hey, well, it looks to me like the market's expecting inflation to rise, right? We're seeing the inflation expectations ratio chart here looking like it was going to break out. We saw the gasoline fund looking like it was going to break out. And what happened was the market priced in that gasoline potentially was going to break out and that inflation was going to continue going higher. But we actually didn't end up getting that, right? And so this turned into a little bit of an oops. So, you take profit, you capitalize off of the initial outlook that looked like we were going to break out, and the market started pricing that in, which is why you saw the inflation expectations chart break out. But then it readjusted and you saw gasoline rolling over here. And now it looks like we had a little bit of an oops up here, right? And we started to see this check back down. So now I'm looking at the possibility of longing bonds, right? And maybe longing something like TLT. And, this is just a brief, very basic explanation of how I like to use this chart. It's really good. It's really simple once you start to understand the concepts, and it can really help give you an edge when you combine this with some technical analysis or maybe some other intermarket relationship charts. All right. Thank you guys for watching. If you enjoyed today's video, I've got multiple packages that you guys can purchase using the links in the description below for intermarket relationship chart layout packages, market breadth, market internal, and a few others as well. And if you've already purchased those, thank you guys a lot. Thanks for watching, and I'll see you in the next chart layout explanation video.